Okay, picture this. You're looking at what's supposed to be the fairest, most efficient market on the planet, the U.S. stock market. Now, what if I told you that whole thing was, well, kind of rigged? Silently, legally, invisibly skimmed by some kind of technological ghost.
Yeah, it really does sound like science fiction, doesn't it? But that ghost, that tech phantom, it was very real. And today we're doing a deep dive into Michael Lewis's book, Flash Boys, The Fight Against High-Frequency Trading. It lays it all out.
Right, and our mission here is to unpack exactly how this high-frequency trading, HFT, basically hijacked the system. We want to understand how it was costing regular investors billions and, the amazing true story of this small team that actually fought back.
They didn't just fight back, they built something incredible. A sort of ingenious speed bump, really, right in the heart of the financial system.
Exactly. So we're here to give you the inside track on understanding these hidden mechanics of modern finance. Let's get into it.
Okay, so the story really kicks off around 2009. Our main character, if you will, is Brad Katsuyama. He's a trader at the Royal Bank of Canada, RBC, based in New York. Pretty straight shooter by all accounts.
Yeah, not one of the flashy Wall Street types. He just wanted things to work properly, efficiently.
But that was the problem. Efficiency was, impossible.
Hmm.
He and his team kept seeing this really weird, maddening thing happen.
What was it?
They'd see an order pop up on their screen, let's say 10,000 shares of some stock available for $20.
Yeah.
Looks good, right?
Standard stuff, yeah.
So they hit buy. Instantly, poof, the shares just vanish from the screen. Gone.
Vanish, like completely.
Completely, only to reappear like a split second later, but now they're priced just a tiny bit higher. Maybe $20.02.
Ugh, that's infuriating. So every time they try to buy...
Someone, or something, was faster. It knew their intention the moment they acted and beat them to the punch, raising the price just slightly. It felt, well, Brad called it the ghost in the machine.
Okay, a ghost. But this wasn't just, annoying for him, right? This had bigger implications.
Oh, huge. This wasn't just happening to RBC. It was happening across the board to all the big institutional buyers. Think mutual funds, pension funds.
Money that belongs to ordinary people, basically. Your 401k, maybe.
Exactly. Anyone trying to buy large blocks of shares was getting nickeled and dimed constantly. And those tiny 2 cents, they add up incredibly fast.
How much are we talking?
Billions. Billions of dollars a year being skimmed from ordinary investors, purely because of this speed advantage. It wasn't a glitch. It was a system, a very profitable one for whoever was behind the ghost.
So Brad knew he had to figure this out. Who was the ghost? What was going on?
Right. He pulled together this small team, really smart, curious people, and they dug in and they found the name for this ghost. High-frequency trading. HFT.
HFT. Okay, so what is that exactly?
At its core, it's a race, an arms race, really, to minimize latency.
You mean delay?
Yeah, the tiny, tiny delay it takes for information, like a buy order, to travel from point A to point B. HFT firms weren't investing millions in companies. They were investing hundreds of millions in technology fiber optic cables, servers right next to the exchange computers, just to get information milliseconds, even nanoseconds, faster than everyone else.
Lewis uses a great analogy in the book, doesn't he? The farmer's market one.
He does, yeah.
Yeah.
It makes it really clear. Imagine you're walking towards a stall selling apples for $1. You want those apples.
Okay.
Now, someone on a super fast electric scooter sees you heading there. They zip ahead, buy all the dollar apples literally seconds before you get there.
Jerk.
Totally. And then, because you still need apples and they have them all, they turn around and sell them back to you for, say, $1.02.
So they made 2 cents per apple without any real risk?
Thanks by being faster. Exactly. Pure profit from speed, not from, actual investing or believing in the apple farmer. That's HFT in a nutshell. But in the stock market, it's way more complex.
Because it's not just one farmer's market stall, right? It's dozens of different places to buy the same stock.
Precisely. You've got the New York Stock Exchange, NASDAQ, BATS, regional exchanges, these things called dark pools. It's fragmented, deliberately fragmented, actually.
And HFT exploits that fragmentation.
That's the key. So imagine a big pension fund wants to buy, say, 100,000 shares of IBM. To get the best price, their order has to be split up and sent out to all these different exchanges almost simultaneously.
Okay, makes sense.
But almost is the key word. Because of physics, light speed, the order might hit the exchange in New Jersey a millisecond before it hits the one in Chicago.
I see where this is going.
The HFT firm, with its super-fast connections, detects that buy order hitting the New Jersey exchange. In that millisecond, Before the order even reaches Chicago, the HFT firm races ahead to the Chicago exchange, buys up all the IBM shares there at the current price.
And then sells them back to the pension fund at a slightly higher price when their order finally arrives.
You got it. Front running, basically. They profit purely from that tiny time lag, the latency between exchanges.
Okay, hold on. Front running sounds illegal. If they know someone's about to buy and they jump ahead, isn't that using information they shouldn't have?
Well, that's the million-dollar question, isn't it?
Yeah.
Or rather, the billion-dollar question. Technically, it was legal. The system, the rules, hadn't caught up to the technology. The exchanges actually sold speed advantages, things like co-location, letting firms put their servers right next to the exchange's matching engine.
So the exchanges themselves were enabling this.
In many ways, yes. They were competing for order flow from HFT firms, and speed was the product they sold. It was a structural flaw that HFT firms brilliantly, maybe cynically, exploited.
And the money they spend on speed, it's just mind-boggling.
Oh, absolutely staggering. Hundreds of millions just on infrastructure. Lewis details this one company. It's become legendary now.
The straight cable line.
That's the one. They spent $300 million. $300 million. Not on analysts, not on predicting the market, on building a perfectly straight fiber optic cable between Chicago and New York.
Perfectly straight. Why?
Because light travels faster in a straight line. They drilled through mountains, went under rivers, whatever it took to make it as physically straight as possible.
And how much time did that save them?
3 milliseconds.
0.003 of a second for $300 million.
Yep, that tells you everything you need to know, doesn't it?
Yeah.
3 milliseconds was the difference between making millions on a trade and missing it entirely. The market wasn't about long-term investment anymore for these players. It was about technological arbitrage, pure speed.
Wow. So when Brad Katsuyama and his team finally understood this was the game, this was the ghost, they had a choice.
A huge one. They could have easily reversed engineered what the HFT guys were doing, built their own speed machine, and gotten incredibly rich playing the same game.
The temptation must have been immense.
No doubt. But they didn't. They chose to fight back, to try and fix the system for everyone, which, took some serious guts.
So what did they do? They assembled a team, right?
Yeah, a kind of Ocean's 11 of market structure geeks, a tech wizard, a guy who knew everything about telecom networks and latency, someone who understood the ridiculously complex exchange rulebooks, a small, scrappy team.
And their first step wasn't like blowing the whistle?
No, it was defensive. They needed to protect their own trades first. They built this really clever piece of software.
What'd it do?
It basically acted like a super precise traffic controller for their own orders. When they sent out a big order, the software would chop it up and calculate the exact tiny delays needed for each piece heading to different exchanges.
Okay. Why the delays?
So that all the pieces would arrive at all the different exchanges, New Jersey, Chicago, wherever, at the exact same microsecond. Not leave their system at the same time, but land at the same time.
Ah, so the HFT firms couldn't see the order hit one exchange early and race ahead to the others.
Exactly. It neutralized the HFT speed advantage by making their arrival simultaneous. They basically blinded the ghost.
That's brilliant. Did it work?
It worked perfectly for their own trading,
Yeah.
but then they started thinking bigger. If they could fix it for themselves, maybe they could fix it for everyone.
And that led to the idea of a whole new stock exchange.
Yeah. A radical idea. Let's not just patch the old system. Let's build a new one from scratch, designed from the ground up, to be fair. That became IEX, the Investors Exchange.
Okay, so how did IEX plan to stop the speed demons? What was their secret weapon?
It was almost laughably simple, especially compared to the hundreds of millions spent on straight cables. They called it the magic shoebox.
A shoebox? Seriously?
Well, okay, technically a secure box, but the principle was simple. Right at the point where orders enter the IEX system, they put this box.
And inside the box?
38 miles of coiled fiber optic cable.
Wait, 38 miles just coiled up in a box?
Yep. Every single order coming into IEX, no matter how fast the connection, even from the fastest HFT firm right next door, had to travel through the entire 38 miles of coiled cable.
Why? What does that do?
It creates a delay, a tiny, deliberate delay of 350 microseconds.
Microseconds. That's millionths of a second. That sounds like nothing.
It's almost nothing to a human or even a normal computer. But in the world of HFT, 350 microseconds is an eternity. It's just long enough to completely erase the speed advantage HFT firms get from seeing orders hit one exchange before another.
So it's like a speed bump for data.
Exactly. A perfectly engineered speed bump. It forces everyone, the fastest HFT bot and the slowest pension fund order, to essentially arrive at the IEX matching engine at the same time. It levels the playing field instantly.
That is incredibly clever.
And simple.
Deceptively simple. But Wall Street, they absolutely lost their minds.
I bet. This magic shoebox basically threatened their entire multi-billion-dollar business model, right? The one built on those tiny speed advantages. Completely. They didn't just ignore IEX. They declared war. They fought tooth and nail on the regulatory side, trying to stop IEX from getting approved as an official exchange.
How? What arguments did they use?
Oh, everything. They launched smear campaigns, called Katsuyama and his team naive idealists who didn't understand market structure. They claimed the IEX speed bump was itself market manipulation. Basically anything to discredit them and protect their turf.
Because those 350 microseconds were worth billions to them.
Billions. The fight got really public, especially after Lewis's book came out. It culminated in that famous TV moment where Brad Katsuyama just looked into the camera and said it.
What did he say?
He said, flat out, based on everything they'd uncovered, the market is rigged.
Wow. That must have sent shockwaves.
Huge shockwaves. It forced everyone, regulators, politicians, the public, to confront what was really happening.
And did IEX win in the end? Did they get approved?
They did. Against all odds, against the massive financial and lobbying power of the established players, IEX became a fully licensed U.S. stock exchange.
That's incredible. What did that prove?
Two massive things, really. First, that it was possible to build a fair, transparent market that wasn't predatory. And second, that investors actually wanted it. Big institutions started routing orders to IEX. And the whole controversy, it kicked off major public debate and even led to FBI investigations into certain HST practices.
So looking back at Flash Boys, it's way more than just a complicated finance story, isn't it?
Oh, much more. It's really a story about integrity, about how a system originally designed for something good, helping companies raise capital, letting people invest in growth, got hijacked. Hijacked by technology optimized purely for extracting tiny profits, parasitically, without adding real value.
And the most powerful takeaway for me is the solution. The problem felt impossibly complex: technology, regulations, dozens of exchanges, billions of dollars.
But the fix was that shoebox, that coil of wire. It shows how sometimes just a few principled people with a really smart, simple idea can challenge and even change these massive entrenched systems.
Yeah, it's about ingenuity overcoming brute force, almost.
That's a great way to put it. And that's really the relevance for you, the listener, today. Brad's team proved you don't always need some massive, top-down regulatory overhaul, which can take years. Sometimes, a clever, targeted intervention, that literal speed bump, can restore fairness pretty effectively.
Which kind of leaves us with a final thought, doesn't it? Something for you to mull over. What systems in your own world, maybe your industry, your company, even just parts of your daily life, feel like they might be subtly rigged by speed or complexity?
Right. And what might be the simple, maybe even low-tech speed bump that could level the playing field or bring back a sense of fairness or integrity to that system?
The ghost in the machine was real, but it turns out 38 miles of cable could trap it. Sometimes the simplest answers are the most powerful.
Well said. It's a fascinating case study.
Absolutely. Thanks for diving deep with us on this one today.